In this video, we are going to solve Mumbai University question paper of April 2016 for TYBcom students who are in semester 5 and subject management accounting. First question. Following is the trial balance of Bubbly Limited as on 31st March 2015. Trial balance, particular debit column, credit column, equity share capital 2 lakh, opening stock 30,000, wages 40,000, interest 8,000, sales 2,50,000, selling and distribution expenses 15,000, profit on sale of investment 5,000, accounts payable 50,000, administrative expenses 20,000, purchases 70,000, land and building 1,50,000, investment 50,000, 8% debenture 8 lakhs, discount on issue of debenture not yet return of 5,000, cash and bank balance 5,000, accounts receivable 1 lakh, prepaid expenses 10,000, plant and machinery 1 lakh, fine paid 2,000. Okay. So these are the information of the trial balance. Other information, closing stock as on 31st March 2015 is rupees 20,000. Fine. Second, make provision for income tax of rupees 30,000. Okay. Third, provide for final dividend 20,000. You are required to prepare vertical income statement for the year ended 31st March 2015 and vertical balance sheet as on that date for financial analysis. So we'll have to prepare vertical income statement as well as vertical balance sheet. So let's start. Solution. Bubbly Limited income statement for the year ended 31st March 2015. We'll have to prepare particular and 2 rupees column. So let's start. Gross sales is 2,50,000. Less cost of goods sold. This first we will take opening stock, $30,000. So this then we will take purchases, $70,000. Then wages 40,000. Now you will have to find the total. So total of this is 1,40,000. From this we will have to subtract less closing stock 20,000. So if you subtract closing stock, you will get cost of goods sold, which is 1,20,000. So if you subtract cost of goods sold from gross sales, you will get gross profit. So gross profit is 250 minus 120, you will get 1,30,000. Less operating expenses, and this A will be administrative expenses. So administrative expenses 20,000. B, selling and distribution expenses, it is 15,000. So total of this is 35,000. Now if you subtract this, you will get operating profit before interest. So operating profit before interest will be 95,000. From this you will have to subtract interest, which is 8,000. Then you will get net operating profit after interest, which will be 87,000. Then to this you will add non-operating income, and we have one non-operating income, profit on sale of investment. Profit on sale of investment, that is 5,000. then we'll have to take a total of both, so it will be 92,000. Less non-operating expenses, and this we have one item as fine paid, $2,000. So we will get net profit before tax, which is 90,000. So less provision for income tax, 30,000, and you will get net profit after tax, which is 60,000. So from this we will subtract appropriation, and this is the first item that we have as provision for dividend. In fact, we have only one item, so directly take in the outer column, 20,000. So once we subtract this, we will get retained earning. I can say retained profit, which is 40,000. Fine. Now we will have to prepare a vertical balance sheet. So we'll go for the balance sheet. Balance sheet as on 31st March 2015. Okay. Particular rupees. So let's start. First, we will take sources of funds. In this first, we will take own funds, and under own fund, first is equity, share capital, which will be 2 lakh. Then B, reserves and surplus, under this profit and loss account balance, or you can say retained earning, it will be 40,000 less discount on issue of debenture, 5,000. So if you subtract this, you will get 35,000. So 2 lakh plus 35,000, you will get owned fund, which is 2,35,000. Then we'll go for second, loan fund, and the first item that we are going to take is a secured loan, and under this we have 8% debenture, which is 1 lakh rupees. So now you can take the total. You will get the total of liability side, that is 3,35,000. Now we'll go for second, which is application of funds, and the first one is non-current asset, and this A will be fixed asset. Under fixed asset we have tangible assets. Under tangible asset we have land and building, which is 1,50,000. Then you have plant and machinery, which is 1 lakh. So total tangible fixed asset that you have is 2,50,000. B, you can say non-current investments. So under this we have investments, which is 50,000. Then we can go for next. Before that, let me increase height of the column. Yeah, now we can go for the second item, working capital. So let me start the working capital in the fresh page. So fresh page, we will say second working capital. Under this, the first one is current assets. Then in this, quick assets. The quick asset, account receivable. One lakh. Cash and bank balance 5,000. So the total current asset that we have is 1,05,000. And second, non-quick, or you can say other current assets. On this we have prepaid expenses, which is 10,000. Then we have inventory 20,000. So total 30,000. Now if we take the total of this, we will get total current asset. So our total current asset is 1,35,000. Okay. Now B, current liabilities. We will say less current liabilities, B, current liabilities. Under this, the first item that we are going to take is quick liabilities. And under quick liability, the first item that we have is accounts payable, which is 50,000. Then provision for tax, 30,000. Then provision for dividend, that is 20,000. So our total current liability, because we don't have non-quick liability, will be 1 lakh. So if you subtract this, you will get working capital. So our working capital is A minus B. So it is 35,000. Right. Now we will have to add the total of the asset side. So we will say total of asset side. So total of asset side, if you see, 2,50,000 plus 50 and 35,000. So that will give you 3,35,000. So balance sheet is telling right. Now let us go for the next question. Following are the trading and profit and loss account of Chaitali Limited for the year ended 31st March 2014 and 15. Fine. Trading and profit and loss account for the year ended 31st March 2014 and 15. Debit side, you can see you have opening stock 1,20,000, 1,50,000, purchases 2 lakh, 4 lakh, carriage inward 10,000, 30,000, gross profit carried on 65,000, 1,10,000. Office expenses 30,000, 25,000, selling expenses 15,000, 30,000, finance expenses 5,000, 10,000, net profit 15 and 45,000. Credit side, we have sales 2,50,000 and 4 lakh, closing stock 1,50,000, 2,90,000, and gross profit. Fine. Prepare a comparative income statement from the above in vertical form. Okay, let us start. Solution. Chaitali Limited, comparative statement, income statement for the year ended 31st March, as it is comparative, so we cannot write the year. Now here one thing what we are going to say is like the base year. So we will say that the base year is 2014, the first year. First year will always remain your base year. Let us prepare the columns. So this many columns we'll have to prepare. Particular 2014 rupees, 2015 rupees, increase or decrease, percentage of increase or decrease. We'll have to follow the vertical format. Sales will number this as A, 2,50,000, 4 lakh, less cost of goods sold, opening stock 1,25,000, 1,50,000, purchases 2 lakhs, 4 lakhs, carriage inward 10,000, 30,000. Right now, you like we'll have to take the total of this. So 1,23,25, 335, 3,35,000 is the total of 2014, and here in this case 550, 580, 5,80,000 is the total. Right? Excuse me. From this, we'll have to subtract closing stock. So closing stock is 1,50,000 for 2014, and 2,90,000 for 2015. Now you will have to subtract and find out B. So in first case, B is 335 minus 150, 1,85,000. And in 2015, 5,80,000 minus 2,90,000, so that will give you 2,90,000. Okay. Next, we'll have to calculate gross profit, which will be A minus B. So we will number this as C. So let us calculate. 250 minus 185 will give you 65,000. So 65,000 is our gross profit for first year. Same way we'll have to calculate for second year. 4 lakh minus 290, that is 1,10,000. And from this we will have to subtract operating expenses. And this first, office expenses, 30,000. And 25,000. Selling expenses, 15,000 and 30,000. Finance expenses, 5,000 and 10,000. Right. Now we'll have to calculate D. So let us calculate 30, 45, 50,000 first year, and second year 65,000. Right. So now we will have to calculate net profit. So our net profit will be C minus D. So C minus D, 65 minus 50,000, you will get 15,000, and 1,10,000 minus 65,000, you will get 45,000. Okay, so we are ready with the vertical income statement of 2014 and 15. Now we'll have to find out the increase and decrease actually. So if you see the first item, that is sales, there is an increase. There is an increase of 1,50,000. So we will say 1,50,000, there is an increase. We'll have to calculate the percentage, as the base year is 2,50,000. So we'll say 1,50,000 into 100 divided by 250, 60%. Then Opening stock again is a increase of 25,000. Let us find the percentage. So 25 into 100 divided by 125, so that will give you 20%. We don't have to actually write percentage because on the top already we have written percentage. So next, purchase, there is an increase of 2 lakhs. Percentage will be 100%. Carriage inward, there is an increase of 20,000, which is 200%. Then total 580 minus 3,35,000, 2,45,000. Percentage 2,45 into 100 divided by 335, that will give you 73.13%. Closing stock 290 minus 150, so there is an increase of 1,40,000. 140 into 100 divided by 150, 93.33%. Again, total of B, total B 290 minus 185, which is 1,05,000. 1,05,000 into 100 divided by 185, that is 56.75%. Gross profit 1,10,000 minus 65, that is 45,000. Percentage 45 into 100 divided by 65, that is 69.23%. Office expense, there is a decrease of 5,000, so we'll have to put in the bracket. And percentage, so 5 into 100 divided by 30, 16.67, 16.67%. Selling expense, there is an increase of 15,000, 100%. Finance expense, there is an increase of 5,000, again 100%. Total, there is that is D, there is an increase of 15,000. That is 30%. Net profit, there is an increase of 30,000, which is 200%. So this is how we have to solve the comparative income statement. Now let us go for the next question. Following is the balance sheet of Kedar Limited as on 31st March 2015. Balance sheet as on 31st March 2015. Liability side, equity and liabilities, equity share capital of 2 lakh, 10% preference share capital 2,50,000, general reserve 1,50,000, profit and loss account 30,000, 12% debenture 1,20,000, creditor 3 lakh, bills payable 80,000, outstanding expense 20,000. On this asset side, we have fixed asset 4,50,000, investment 2 lakh, stock 75,000, data 250, bills receivable 1,25,000, cash 40,000, premium expenses 10,000. Prepare a common size balance sheet from the above in vertical form. So let's start. Solution. Kedar Limited, we will write common size, balance sheet as on 31st March 2015. Okay, so let us prepare common size. We'll have to prepare 3 rupees column and 2% column. Particular rupees column, 3 rupees column, and there will be 2% column. Let's start. First will be sources of funds, and under this we will write own fund, then share capital, equity capital, ₹2 lakhs, %, preference share capital, 2,50,000. So total of this is share capital, total share capital 4,50,000. Then B, reserves and surplus, in this general reserve, $1,50,000. Profit and loss account, 30,000. Then we'll have to calculate the total. So total of these two is 1,80,000. From this we will have to subtract preliminary expenses, which is 10,000. So once you subtract this, you will get total reserves and surplus, which is 1,70,000. So now total own fund will be 450 plus 170, which is 6,20,000. Alright, then we'll go for the second one. Loan fund. This A, secured loan, and this 12% debenture. We have only one item, so directly we can take this in the outer column. 1,20,000. So the total of the asset side is 7,40,000. We'll go for the second one, that is application of fund. There's the first one, non-current assets. And this A, fixed asset, into this tangible asset, and what tangible asset is 4,50,000. B, non-current investment, and this will take investment. So investment is 2 lakhs. So total of non-current asset, that is fixed asset plus investment, will be 6,50,000. Now let me increase the size of the column. Now the second item that we are going to take is working capital. In this, first we will have to take current asset, under current asset, quick asset, then data, the amount of data is 2,50,000. Bills receivable, is 1,25,000. Cash 40,000. So the total of this will be let me calculate, 250 plus 125 plus 40, that will give you 4,15,000. To this you will have to add non-quick assets. And in non-quick we have only one item, that is stock. So we can take this stock directly in the first column, 75,000. So 4,15,000 plus 75,000 will give you 415 plus 75 will give you 4,90,000. That is our total current asset. Then B, current liability. In current liability also, the first item that we are going to take is quick liability. Quick liabilities. Now find out all the quick liabilities and record here. So creditor 3 lakhs, then bills payable 80,000, then outstanding expenses 20,000. Total current liability is 4 lakh. Now if you subtract current liability from current asset, you will get working capital, which is 90,000, right? So if you take the total of the asset side, that is total of non-current asset and total of non-current liability, that is 650 plus 90, that will give you 7,40,000. So you can see our balance sheet is tallying. $7,40,000 is the total of liability side, and 7,40,000 is the total of asset side, right? Now just we will have to calculate the percentage. Now in this case, what we are going to do, we will have to take total of asset as 100%. So this we will assume as 100%. Now based on this, you will have to calculate the percentage of all other amount. So 1 divided by 7,40,000 will give you we'll say 100 divided by 7,40,000. Whatever we are getting, multiplication sign twice, 90,000. So if we take the percentage, $90,000 we are getting as 12.16%. And 4 lakh as 54.04%. And then 4,90,000, 66.20. Then 2 lakhs, 27.03. And 6,50,000 as 87.84. And then 4,50,000, 60.81. So 7,40,000 will be 100% only. 1,20,000, 16.22. One lakh 70,000, 22.98. And 6,20,000, 6,20,000. Oh, sorry. 6,20,000. It will be 83.78. 83.78. Fine. Then 4,50,000. It is 60.80. So this is how we'll have to solve this sum of common size in the exam. Let us go for the next question. From the following balance sheet of Chetan Limited, prepare trend percentage statement in vertical form. Particular 2013, 14, 15. Equities and equity and liabilities, equity share capital 500, 800, 900. 12% preference share capital 400, 200, 300. General reserve 120, 210, 280. 14% debenture 100, 250, 150. Creditor 80, 120, 140. Bills payable 100, 80, 60. Outstanding expense 20, 30, 10. Total is 1320, 1690, 1840. Fixed asset 500, 700, 700. Investment 300, 330, 420. Stock 200, 100, 200. Data 150, 200, 250. Bills receivable 90, 270, 200. Cash 50, 70, 60. Preliminary expenses 30, 20, 10. So total is 1320, 1690, 1840. What we are supposed to prepare? We will have to prepare trend. Solution. Chetan Limited. Balance sheet as on 31st March. Base year will be 2013. We'll have to prepare 3 rupees column and 3% column of 3 different years. Particular 2013 rupees 2014 rupees and 2015 rupees. The same way, percentage column, 2014 percentage column, and 2015 percentage column. So now we can start. First, sources of funds, and this first will be own fund, A, share capital, equity share capital, 12% preference share capital, so equity share capital is 500, 800, 900. Preference share capital 400, 200, 300. So total will be 900, 1000 and 1200. Okay, so next B, reserves and surplus. General reserve, $120, $210, $280, less preliminary expenses, $30, 20, 10. So $120 minus 30, you will get 90. 210 minus 20, you will get 90. And 280 minus 10, you will get 270. This will be your 190. $270. So let us name this as A and this as B, right? So we will get sources of fund A plus B. A plus B will be our sources of fund, which is 990 in case of first year, 1,190 in case of second year, and 1,470 in case of third year. This is our total sources of fund. You can number this as 1. Now we'll go for second. That is sorry, not this second, number 2, loan fund. In loan fund we have only one item, that is 14% debentures, 100, 250, then 150. So let us number this as 2. Now let us calculate the total. is 1 plus 2. So in first year it will be 1090. Second year it will be 1190 plus 250, 1440. Third year 1470 plus 150, 1620. Okay, so this is a total of asset side. Now same way we will have to calculate the total of liability sides, asset side. Application of fund in this first will be fixed asset, then non-current investment, so let us number this as A, non-current assets. This will be first year 800, second year 1030, (1120). Now we'll go for B, that is working capital, and this the first item A, current assets, and the stock 200, 100, 200. Let me increase the size of the column. Status 150, 200, 250. Bills receivable 90, 270, 200. Cash 50, 70, 60. So your total current asset will be 490 of first year, $640 of second year, and 710 for third year. B, current liabilities, creditors 80, 120, 140. Bills payable 100, 80, 60. Outstanding expenses 20, 30, 10. So total of B will be 200 of the first year, 230 of the second year, and 210 of the third year. So now the working capital which will be A minus B so 490 minus 200 will give you 290 of the first year, 640 minus 230, 410 for the second year, 710 minus 210, 500 of the third year. Now let us take the total. This is our capital B. So we will say A plus B. 800 plus 290. So first year we're getting 1090. Second year 1030 plus 410. We are getting 1440. Third year 1130 plus 500, 1620. So you can see our balance sheet is tallying. Okay. Now we'll have to calculate the percentage wherein the first year will be our base year. So first year we will say 100%. Accordingly we will calculate the second year. So we will say 800 into 100 divided by 500, 160%. 900 into 100 divided by 500, 180%. Same way. Next. So this is how we will have to solve the trend analysis. Now we can go for the next question. Vinod Limited furnishes you their balance sheet as on 31st March 2015 with some additional information. Balance sheet as at 31st March 2015. This is your equity and liability side. Equity share capital 6 lakh, 10% preference share capital 6 lakhs. Or reserve for 90,000, profit and loss account 75,000, 12% debenture 4,50,000, 15% term loan from bank 3 lakhs, sundry creditor 1,20,000. Last year 90,000, bills payable last year 75,000, current year 1,05,000, bank overdraft 30,000, depreciation provision 3 lakhs, provision for income tax 1,50,000, proposed dividend, that is provision for dividend 1,80,000. Land and building at a cost 2,50,000, building at cost 6 lakh rupees, plant and machinery at cost 3 lakh rupees, furniture at cost 2,25,000, vehicle at cost 5,25,000. Sundry debtor last year 2,40,000 and current year 3,30,000. Bills receivable last year 1,95,000, current year 2,85,000. Stock last year 2,10,000, current year 1,50,000. Cash and cash equivalent 1,80,000. Prepaid expense 15,000. Advance income tax 1,20,000. Discount on issue of debenture 15,000. Further information: total sales for the year rupees 40 lakhs, 70% on credit. B. Gross profit rate 25%. C. Profit before tax is 4,20,000. From the above information, you are required to calculate the following ratios and offer your comment only on quick ratio. So we'll have to give the comment only on quick ratio. Current ratio, we'll have to calculate current ratio, quick ratio, return on shareholders fund, debt service ratio, capital carrying ratio, creditor turnover ratio, debtor turnover ratio. Note: converting statement into vertical form is not expected, so we don't have to prepare vertical statement of this. Okay, so directly we can go for current ratios. We can calculate the current ratios. So let us start. Solution. First we are going to calculate current ratio. The formula for current ratio is current assets upon current liabilities. So let's see what all things can we take in current asset. Current asset we can take sundry debtor, bills receivable, stock, cash and cash equivalent, prepaid expense and advance tax. So this many items we can take as current asset, and current liability we can take sundry creditor, bills payable, bank overdraft, provision for income tax and proposed dividend, that is provision for dividend. So let us record debtors plus bills receivable plus stock plus cash plus prepaid expense plus advance tax. right? Then in current liability we can take creditors, bills payable, bank OD, provision for tax, provision for dividend. So this many item we can take as current liability. That is equal to like 30,000 so that is equal to so current ratio is 1.85. We can say is to 1. .85 is to 1. Okay, now we'll calculate quick ratio. In quick asset we will take current asset minus prepaid expenses minus advance tax minus stock. And in current liability we will take current liabilities minus bank overdraft. Fine. So current asset is 10,80,000, which we got from the current ratio, minus prepaid expense, which is 15,000, minus advance tax, which is 1,20,000, minus stock 1,50,000. Current liability 5,85,000 minus 30,000, so that is equal to 7,95,000 divided by 30,000, 5,55,000. So that is equal to 7,95,000 divided by 5,55,000. 1.43. 1.43 is to 1. go for third. Return on shareholders fund, that is equal to net profit after tax into 100 net profit divided by tax, net profit after tax upon shareholders fund into 100. We will see net profit before tax minus provision for tax. And how to calculate shareholders fund? Equity share capital plus preference share capital plus reserve fund plus profit and loss minus discount on issue of debenture. And whole into 100. So net profit before tax is 4,20,000 minus provision for tax is 1,50,000 equity share capital 6 lakhs plus preference share capital 6 lakhs plus reserve fund 75,000 minus reserve fund 75, reserve fund is 95,000, reserve fund is 90,000, profit loss account 75,000. Okay, so small change. I will say reserve 90,000 and plus 75,000 minus 15,000 this whole thing into 100. So we will get 4,20,000 minus 1,50,000, 2,70,000 upon 13,50,000 whole into 100. So that is equal to 20%. So return on shareholders fund is 20%. Fourth, debt service ratio, which is net profit before and tax upon interest. That is equal to net profit before tax plus interest upon interest. That is equal to 4,20,000 plus interest 99,000 upon interest 99,000. So that is equal to 5,19,000 upon 99,000. So that is equal to 5.24 times. Is our debt service coverage ratio. Okay, how we got the interest actually? It's very simple. Let me show you. $4,50,000 into 12%. So that comes to 54,000, and then 3 lakhs into 15%, that comes to 45,000, and this is how we are getting total interest as 99,000. Fine. So we can go for the next part, that is fifth. Capital gearing ratio. Preferential capital plus debentures plus term loan upon equity share capital plus reserve fund plus profit and loss account minus discount on issue of debentures. So preferential capital is 6 lakhs. Debenture is 4,50,000. Term loan is 3 lakhs. Equity share capital is 6 lakhs. Reserve fund is 90,000. Profit and loss account 75,000. And discount on issue of debenture 15,000. Okay, so the next we can say that is equal to $13,50,000 upon sorry, this 15,000 we will have to actually subtract. So it is 6 lakhs plus 90,000 plus 75,000 minus 15,000. So that will give you 7,50,000. And that is equal to 13,50,000 divided by 7,50,000. 1.8. So capital gearing ratio is 1.8. Next we will calculate sixth. Creditors turnover ratio, that is credit purchase upon average creditor. See, we want two things over here. One is the credit purchase and second average creditor. So let us calculate credit purchase first. So for that we need to prepare actually trading account. So let me prepare a small trading account. I will name this as trading account. Credit side, I am going to record the information given in the question. So buy sales 40 lakhs, buy closing stock 1,50,000, and debit side, let us record the information which is given in the question. To opening stock 2,10,000 and to gross profit at the rate of 25%. So 40 lakhs into 25% of sales, so you will get 10 lakhs. So now if you close this account, we'll have to take the total. So our credit side is more, 51,50,000. Okay, and same total we are going to record in the debit side, 41,50,000. Now this thing you will have to subtract. You'll have to subtract the debit side item, that is 41,50,000 minus 2,10,000 minus 10 lakhs. So it is 29,40,000. So we can say two purchases, 29,40,000. To gross profit at the rate of 25%, 10 lakhs. So as purchase is our balancing figure, we will have to circle it, right? So we came to know our credit purchase. Now here we will have to assume that the purchase is on all the purchases are on credit basis. So as no information is given, you will have to assume that all the purchase is on credit basis. Same way, we will have to calculate average creditor. So how to calculate average creditor? Let us do that calculation as well. Average creditor is equal to opening creditor plus closing creditor upon 2. Opening creditor plus closing creditor divided by 2 plus opening bills receivable plus closing bills receivable divided by 2. That is equal to 90,000 plus 1,20,000 divided by 2 plus opening bills receivable 75,000 plus 1,05,000 divided by 2. So that is equal to, let's see, 1,05,000 plus 90,000. So our average creditor comes to 1,95,000. So we got credit purchase as well as average creditor. So we can record here. That is equal to credit purchase is 29,40,000 divided by average creditor is 1,95,000. That is equal to 15.08 times. Okay, then next is data turnover ratio. Point number 7. Data's turnover ratio, that is equal to credit sales upon average data. Now here we want two things, one is the credit sale and the second one is average data. So let us calculate credit sales first. Credit sale is equal to 70% of sales. So that will be 40 lakhs into 70%. So you will get 28 lakhs. So we got credit sales. Now let us calculate average data. Average data is equal to opening data plus closing data divided by 2 plus opening bills receivable plus closing bills receivable divided by 2. So opening data is 2,40,000 plus closing data is 3,30,000 divided by 2 plus opening bills receivable every rupee every rupee of quick liability is supported by rupee 1.43 quick asset or liquid asset are sufficient to pay quick liabilities liquidity position or immediate solvency position of the company is quite satisfactory. Okay. Thank you for watching this video. If you like this video, please do visit our website www.tripathionlineeducare.com for more such videos. Thank you.